Why do so many investors lose money, even when they think they're making smart choices? The truth is, most people make the same costly mistakes over and over again. Even experienced investors fall into traps that Warren Buffett, one of the greatest investors of all time, has warned about for decades. Today, we're breaking down the top 10 investing mistakes that can destroy your wealth, straight from Warren Buffett himself. Avoiding these errors could be the key to building long-term success. Let's dive in. Number 1. Holding too much cash. Many investors believe that holding large amounts of cash is a safe strategy. They fear market crashes and wait for the perfect time to invest. But Warren Buffett warns against this mindset. While cash provides flexibility, it loses value due to inflation. Over time, prices rise, and your money buys less. Buffett emphasizes that money should always be working, whether it's in stocks, businesses, or other productive assets. He never holds cash just for the sake of holding it. Instead, he invests in great businesses whenever he finds them. This doesn't mean you should rush into bad investments. Be patient, but don't let fear keep you from taking action. Too much cash is a missed opportunity for wealth creation. Number 2. Trying to predict the market. Many investors waste time trying to predict where the market will go next. Will there be a crash? Is a bull run coming? Should I buy or sell based on economic news? Warren Buffett says this is pointless. No one, no analyst, economist, or TV expert, knows for sure what the market will do. Even Buffett himself doesn't make investment decisions based on predictions. Instead, he focuses on individual businesses. If a company is solid, profitable, and fairly priced, he buys it. It doesn't matter if the market is up or down. Trying to time the market often leads to missed opportunities or panic-driven decisions. The key to success is thinking long-term and ignoring short-term market noise. Number 3. Over-diversification. Most financial advisors recommend diversification, spreading your investments across many stocks to reduce risk. But Buffett believes too much diversification can be a problem. He calls it a protection against ignorance. If you don't know how to analyze businesses, diversification is a safety net. But if you do understand what you're investing in, owning 30 or 40 different stocks is unnecessary. Instead, Buffett suggests focusing on a few truly great businesses and investing more in them. If you have strong confidence in 3 or 4 companies, why spread your money into dozens of weaker ones? History shows that most great fortunes were built this way, by concentrating investments in high-quality businesses, not by owning everything. Number 4. Misunderstanding risk. Most investors think risk comes from stock price fluctuations. Finance professors use beta to measure risk, saying that volatile stocks are riskier. But Buffett disagrees. Real risk isn't volatility, it's not knowing what you're doing. For example, in the 1980s, farmland prices dropped dramatically. According to traditional finance theory, buying farmland at a lower price was riskier. But Buffett knew the land was valuable and would recover, so he bought it at a discount. That's not risky, it's smart investing. The same logic applies to stocks. If you understand a business, its management, and its value, it doesn't matter if the stock price fluctuates. The real risk is making investments blindly without proper knowledge. Number 5. Thinking intelligence beats temperament. Many people believe that only geniuses can succeed in investing. But Buffett insists that investing isn't about IQ. It's about emotional discipline. A high IQ won't save you if you panic during a market crash or get greedy when stocks soar. Buffett says investing success comes from staying calm, thinking independently, and making rational decisions. He often quotes his mentor Ben Graham. "You're not right because others agree with you. You're right because your reasoning is correct." This means you should trust your research and avoid making emotional short-term decisions. Patience and self-control are more important than intelligence in the world of investing. Number 6. Not investing in yourself. Buffett believes the best investment isn't in stocks, it's in yourself. Your skills, knowledge, and personal development will always provide the highest returns. One key area he highlights is communication skills. Being able to speak and write well can increase your lifetime earnings by 50% or more. Buffett himself took a Dale Carnegie course to improve his public speaking, which he says was one of the best decisions of his life. He also stresses continuous learning. Read books, study great businesses, and never stop improving your mind. Finally, take care of your health. If you were given one car for life, you'd take great care of it. Your body and mind are the same. Treat them well. Number 7. Believing in overcomplicated strategies. Some investors think that successful investing requires complex strategies. They follow fancy asset allocation models and constantly rebalance their portfolios. Buffett calls this unnecessary complexity. He prefers a simple approach: own great businesses and hold them for the long term. Many financial advisors overcomplicate things to make investing seem difficult. But Buffett argues that shifting from 60% stocks, 40% bonds, to 65% stocks, 35% bonds, doesn't make much difference. Instead of getting caught up in fancy strategies, focus on what actually matters: finding strong companies, buying them at good prices, and holding them for decades. Number 8. Treating investing like gambling. Many people approach the stock market like a casino, chasing hot stocks, day trading, or betting on market trends. But Warren Buffett warns, investing is not gambling. It's about owning real businesses. Gambling is based on luck, but successful investing requires research, patience, and discipline. Day traders often buy and sell stocks based on emotions, hoping for quick profits. However, Buffett believes in long-term ownership of quality companies. He advises investors to ask themselves, would I be comfortable owning this stock for 30 years? If the answer is no, it's likely a risky bet rather than a solid investment. Successful investing is slow and steady. If you're constantly looking for fast gains, you're not investing. You're gambling. Think like a business owner, not a gambler. Number 9. Thinking growth and value are opposites. Many investors believe they must choose between growth stocks and value stocks, but Warren Buffett says this is a false distinction. Growth is simply a part of value. For example, the airline industry has grown massively over the decades, but most airline stocks have been terrible investments. Why? Because growth alone doesn't guarantee profitability. A company must grow in a way that increases long-term earnings and shareholder value. Buffett doesn't categorize investments as either growth or value. Instead, he looks at whether a company's future cash flows justify its current price. If a business has strong growth and is fairly priced, it has value. The key lesson? Don't get stuck in labels. Focus on buying strong businesses, regardless of how they are classified. Number 10. Selling great companies too soon. One of the biggest mistakes investors make is selling great companies too early, either out of fear, impatience, or short-term thinking. Warren Buffett believes that if you own a truly great business, you should hold it for decades. Many investors panic when stock prices dip or sell after a small profit, thinking they've made a good trade. But Buffett compares investing to owning a farm. If your farm produces great crops every year, would you sell it just because someone offers you a little more today? Of course not. Great businesses grow in value over time. By selling too early, you miss out on long-term compounding and massive gains. Buffett's advice? Be patient, think long-term, and let great companies create wealth for you. Avoiding these 10 mistakes can make a huge difference in your investing journey. Warren Buffett became one of the richest people in the world by staying patient, thinking long-term, and avoiding these common traps. Which mistake have you made before? Let me know in the comments. If you found this video helpful, don't forget to like, share, and subscribe for more investing insights. Thanks for watching. Until next time, happy investing.